U.S. President Donald Trump's decision to agree to a 2-week ceasefire with Iran triggered strong reactions across global financial markets and prompted cautious optimism among investors and analysts, who viewed the move as a potential step toward easing tensions in the Middle East while warning that significant uncertainties remain. Trump announced the ceasefire on Tuesday, less than 2 hours before a deadline he had set for Tehran to reopen the Strait of Hormuz or face widespread attacks on civilian infrastructure. The announcement immediately influenced financial markets worldwide. Oil prices fell sharply, bonds rallied, and stock markets surged, as investors interpreted the ceasefire as a sign that tensions could de-escalate and Gulf oil and gas exports might resume. According to Reuters, Saul Kavanik, head of energy research at MST Marquee in Sydney, described the ceasefire as an off-ramp from what he called Trump's earlier ultimatum, but cautioned that it does not yet signal a full recovery for oil markets or an end to the war. He said oil and liquefied natural gas production that had been halted is unlikely to resume until markets gain confidence that the ceasefire will last. According to him, the 2-week pause could allow oil and LNG tankers currently held in the Strait of Hormuz to reach markets, easing pressure in May. However, he stressed that this would only release stored supplies rather than increase production. Kavanik also warned that even with a peace agreement, global oil markets could remain tighter by 3 to 5 million barrels per day for years due to damage to export infrastructure that may take months or years to repair. Shingo Aide, chief equity strategist at NLI Research Institute in Tokyo, said the involvement of Pakistan as an intermediary gave the ceasefire additional credibility compared with previous unilateral announcements. He noted growing hope that the temporary arrangement could evolve into a lasting ceasefire if progress continues beyond the 2-week window. However, I'd emphasized that major differences remain between the United States and Iran, while Israel's objectives differ significantly, suggesting that a mutually acceptable agreement among all parties remains distant. Kyle Rada, senior market analyst at Capital.com in Melbourne, called the development a major turning point for markets, saying the reopening of the Strait of Hormuz was particularly significant. He added that oil prices may have already reached their peak during the crisis, although markets could still react sharply to new headlines. Prashant Nunaha, senior rate strategist at TD Securities in Singapore, said markets are treating the ceasefire as credible despite the risk of renewed escalation. He expects risk assets and bonds to rally because the worst-case scenario appears to have been avoided. Still, he noted that oil prices are unlikely to return to pre-war levels, meaning inflation could remain a central concern for investors and potentially slow gains in interest rate markets. Ray Attrell, head of FX strategy at National Australia Bank in Sydney, urged caution, saying markets must remain skeptical about whether Iran fully accepts the agreement. He said uncertainty over oil prices and the time required to repair damaged infrastructure means traders are unlikely to price in a final resolution to the Middle East conflict anytime soon. Overall, investors broadly welcomed the ceasefire as a positive development that reduced immediate risks, while maintaining caution about whether the agreement would hold and how long economic and energy market disruptions would persist.